Welcome to The Responsible Resident. I'm Amber Stitt. This podcast takes a common sense approach to financial decisions for physicians, breaking down complex topics into something clear, practical, and usable. Because you shouldn't have to have a finance degree to build financial freedom. In this podcast, we break down complex financial decisions into clear, practical steps so you can understand your options early and make informed decisions over time. Today, we're answering a common question that comes up when reviewing disability insurance. Should you add a cost of living adjustment, also known as a COLA or inflation rider, to your contract? At a high level, this comes back to one concept: preserving purchasing power. A COLA rider is designed to increase your monthly disability benefit over time to help keep up with inflation. As you already know, the cost of housing, food, utilities, and everyday living tends to rise over time. If your benefit stays flat for many years during a disability, its real-world value can slowly decline. A COLA rider is designed to address that by increasing your benefit while you're on claim. Now here's one of the most important details, and one that often gets misunderstood. COLA does not increase your benefits while you're healthy and working just because you have purchased the feature. It only activates under very specific conditions. You would need to become disabled, and you would need to remain on claim for at least 12 months. After that first year, your benefit will credit at month 13 by usually 3%, depending on how the rider is structured. So this feature is specifically designed for long-duration disability scenarios and must be purchased upfront. There are generally two ways COLA adjustments are calculated. The first is a fixed percentage, often around 3% or 6% annually, which provides predictable increases. The second is CPI-based, meaning it is tied to inflation using the Consumer Price Index. These adjustments can vary year to year, and the ranges today are 0 to 3% based on the CPI index at the time of claim. Each structure behaves a little differently, but the goal is the same: to help your benefit keep pace with rising costs over time. Now here's where the real decision comes in, and this is where I want you to think a little differently. The question isn't just, what does COLA do? The better question is, how are you choosing to allocate your premium dollars? Because every dollar you put toward a COLA rider is a dollar that could have gone toward higher base coverage today. And those two approaches behave very differently at claim time. Increasing your base benefit gives you more income immediately if you become disabled. COLA provides gradual increases later, starting after the first year of being disabled. So this is not just a feature decision, it's a design decision. I'd like to take a second to tell you about a free medical professionals blueprint that I created with you in mind. At some point in your career, you realize it's not just about making more money. It's about making decisions that actually support your life. That's exactly why I created the Pathways Perspective for Physicians. It's a simple, non-technical framework to help you think through your career, your money, your risk, and how everything connects as your life evolves. You shouldn't have to have a finance degree to build financial freedom. You don't need to have everything figured out. You just need a place to start. You can download the free Medical Professionals Blueprint at stittstrategies.com/blueprint. Another important consideration is timing. Because COLA only begins after the first year of disability, it can take many years for those increases to compound in a meaningful way. In some scenarios, it may take a decade or more of continuous disability for the cumulative value of a COLA rider to exceed what you could have received by simply increasing your base benefit up front. It's also important to recognize that not all disability claims last decades. Some physicians recover and return to work. Some transition into other roles. Others reach retirement. So the value of COLA is directly tied to how long a claim actually lasts, not just how the feature looks on paper. So when does COLA tend to make sense? It's often considered reasonable for physicians who want built-in inflation protection inside the contract, who are younger, in training. Someone who has already maximized their base coverage limits and prefers guaranteed growth within the contract rather than relying on external financial growth should buy this feature. On the other hand, some physicians choose not to include COLA because they are building investment portfolios, increasing income over time, or planning to manage inflation through other financial strategies. Both approaches can work. Before deciding on optional features like COLA, it's important to focus on the foundation of your contract. That includes your definition of disability, your benefit amount, your residual coverage, your elimination period, and your future purchase options. These are the features that determine how your contract performs immediately at claim time. COLA is a secondary layer. It enhances long-term outcomes, but it doesn't replace core protection. Here's how I typically guide physicians on this decision. If you're unsure whether to include COLA, it can be reasonable to include it upfront because you have the option to remove the rider later. That gives you flexibility as your career and financial situation evolve. But you can't always go back and add it later without going through underwriting again and repricing the whole contract. So when you're on the fence, including it initially can help preserve your options while you gather more clarity over time. A helpful way to think about this is to ask yourself, if I experienced a long-term disability, how would I want to manage inflation risk? Would I prefer guaranteed increases inside the contract, or would I rely on external financial growth and flexibility? There's no one-size-fits-all answer. The goal isn't to build the most feature-rich contract. It's to build one that performs the way you need it to when it matters most. Understanding how features like COLA actually work gives you the ability to make more confident, informed decisions over time. If you'd like help reviewing your disability insurance options, you're welcome to connect with our team. My partner, Scott Nelson Archer, and I work with physicians nationwide through MD Disability Quotes, helping you understand how these contracts are structured and how to design coverage that fits your career. Our goal is to provide a clear, independent perspective so you can make responsible decisions about protecting your future income. In the next episode, we'll walk through how a catastrophic disability rider can enhance your coverage in more severe scenarios. Some of our clients buy COLA and CAT together, and some pick just one. Let's find out what is best for you. Thanks for listening, and please be sure to give us a follow so you'll be notified when we release more educational content like today's podcast. If this episode helped you think a little more clearly about your next step, that's the goal. You don't need to have everything figured out, but you do need to take ownership and take a meaningful step forward today. Thanks for listening to The Responsible Resident. As a reminder, this podcast is for general educational purposes only. It is not legal, tax, or individualized financial advice, and coverage options will vary based on your personal situation.